Good morning, everyone, and welcome to the July 20th, 2022 version of Morning Notes, following quite a day yesterday. But for those of you who've been listening and are subscribers, there should be no surprises other than it takes a long time to bottom a 40-week cycle. So let me start there. We're going to try to go fast this morning. Obviously, we've only got about 25 minutes to the open and definitely want you to have this perspective. So I've been talking since the June 17th low about the Hearst Cycles. Now, Hearst Cycles are a lot like Elliott Wave. There's sort of an art form to them. Their background information, because they don't come in, precisely on the day you want them, but it's something, again, to have in your awareness, and certainly something I've had in my awareness now since the June 17th low. So let me talk about that low. A lot of people have been waiting for one of these spike down capitulation moves, et cetera, et cetera. And as I've been discussing here on the channel, we did have a capitulation into June 17th. It was one of the most powerful downdrafts. I think the second most powerful in history. When you look at velocity, when you look at breadth, when you look at a lot of the things that really matter. Now, maybe it didn't do one of those drastic spikes like we got used to back in 2017, 2018, but it was good enough. So that was your first alert that something interesting was probably happening. And don't forget, by the way, in all of this, that, the broad stock market's been slaughtered. And the only reason, even the NASDAQ 100 is down 50%. The only reason the S&P hasn't gone to that level is because the energy stocks in this particular cycle happen to offset some of the other losses. Otherwise, the S&P would look a lot worse than it is. It just happens that that rotation saved it from the abyss. But in any event, the June 17th low is a low on the 18-month, the 9-month cycle. Let me get my highlighter on here, which is one of the most important intermediate cycles we encounter in swing trading. The only thing larger than that is the 18-month cycle, and that cycle low isn't due until early next year and probably will be the bottom of this bear market. So we expected that this June 17th low was a 40-week or 9-month cycle low, but of course it takes a while. And in this case, it's taken a month to confirm that. The larger the cycle, the longer it takes to confirm a bottom. So, but in any event, I want you to recognize that this is an important inflection point. And as I've been saying this entire time, I expected a more significant rally from here, not unlike we saw in 2008, 2009. If you look and study any bear market in the 8th or 9th month of that bear, we get a more significant advance than we'd seen previously. And in this case, if you even take the measured move of this area here, we're going to come back up into the 4100, 4150 area. And if I were to take you back, this is a weekly chart of the S&P. If I were to take you back to 2009, just briefly, we're right in this zone here. And in 2009, we got a nice rally about halfway up from the losses, and then we started back down again. And I don't, if this is a generational secular bear market, I expect something very similar. Now, the possibility still exists that this is a cyclical bear, meaning it doesn't retrace that kind of drastic move. Only time will tell. In my best judgment right now, I think we rally up into here, into late August, and then we'll see where we're at. Obviously, there's a lot of bad news out there, and it's a very, very treacherous environment. But that's baked in. Tell me what the market doesn't know right now. So that's just kind of where we're at. So be aware of that. And that's why we are getting a more powerful move, as we saw yesterday. And you can see from these tails on the weekly chart that, there was a lot of buying down in here. So I think that's definitely something to make note of. Now, the other thing I want you to note is that we have now flipped into positive gamma. And that's a very significant event as well, because in general, then dealers are going to buy dips and sell rallies instead of, selling into declines and buying into rallies. So the volatility is going to come down. And this is my new favorite way of looking at things. This is the daily chart mega macro volume profile. And this is a good roadmap for where we're headed. And remember, I've been saying if we could get over this hill, which sits around 39.05 to 39.30, that would be a significant accomplishment. And we certainly did that yesterday. So we've been climbing up to the top here where we will encounter resistance. Every one of these peaks is going to be a hurdle to get over, whether you're going down or up. And in this case, we did get past that peak pretty phenomenally yesterday. And again, this, if you're paying attention, this is everything I've been talking about. And I also have been mentioning the rocket pocket here. Well, this whole pocket, which shows lack of volume at price, is where that capitulation fell through. So there's not a lot of activity to fight through this area. And clearly, right here from about 39.86 to 40.42, there is not a whole bunch to stop this market. So this is the rocket pocket I keep talking about. And what I've said is, if we can get up into this area, we're going to fly through here. So, there is an obstacle in our path right now, which I'll talk about, but just be aware of that. This is going to be formidable resistance. And these are all the gamma strikes here. So you can see it framed the peak here. We've gotten past the volatility trigger. And let me just turn the actual price chart on here so you can see where we're at. Here's the capitulation coming into here. And here's where we're at right now. So the price is sitting here between the volatility trigger and the gamma flip. So that's where we sit as of this morning. Here's the overnight price bar, and here's where we closed yesterday. All they did overnight is they ran the stops above these highs back on the 27th, brought it back in, and we'll see what happens from there. But this is some resistance. We will encounter a little bit of resistance here. And I suspect that when we get back up into here, we will fly through that area, and the next really major resistance will be around 40.50 to 40.62. So let me turn a couple of these things off, and let's look at some other things. Let's get into our sandbox, because that's very important today. And just a second here. And I'm going to turn the price back off again. Now, these are all of, I've marked all the volume nodes here, which again is important to analyze for support and resistance. But let's look at our sandbox. First of all, let's look at the week. Okay, I've got this showing up in two areas. Let me turn on the price just for a second there so you can get a sense for where we are. Now, we are at the top of the weekly expected move, okay? It sits right up here at 39.64. That's where we topped out last night. So that may hold us back for the rest of the week. I don't know, in a case like this where there's a lot of people short and coming in, it may not hold. And of course, you all know that we can violate that midweek and come back. We've seen that over and over again. But there's a 70% probability we're going to close within that range by Friday. So keep that in mind. This could end up being an exception. These are things we want to have awareness of. But clearly, that is what held the market back overnight. So keep that in the back of your mind. And I always keep these ranges up on my chart so I'm aware of them. So keep that in mind. Now, Here's the expected move for today, and let me overlap them for a minute. You can see that today's expected move is actually a little bit outside of the weekly expected move. And like I said, on a Wednesday, that can happen. The dealers can bring it back before the end of the week. So, but the top of our expected move is about roughly, it's roughly 3,900. I mean, 4,000. Yeah. Now, let's see. 38.9850, somewhere in there. I think that's supposed to be 39.9850 actually. So, oh no, I'm sorry. 39.7650 is the top, and then 38.9850 is the bottom. So this is our sandbox for today. This is our sandbox for the week. Obviously, we're exceeding it. Keep that in mind. Looks like we're going to open within range, so we don't have to worry about a gamma adjusted gap. But these are, this is where our activity is expected. And what we care about is what we're going to encounter there in terms of whether it's moving averages, whatever it might be. What I'm going to do now is I'm going to turn off the interior here. I'm going to turn off the weekly expected move so we can just focus. Now, yesterday, we took out every major moving average that was in our way. I'm talking about the 5-week, we're now above all the major averages on the daily chart. So those should now be looked at for support. So there's the 5-week. We took that out yesterday. And we took out all the 21, the 5-day, the 50, all of those have been conquered now. So I would keep focused on the 5-day moving average now as a potential support zone. If we were to take that 5-day moving average out, I would get more negative. But that needs to hold now, as do the other moving averages. And now we do have the crosses. Remember at the beginning of the week, I was talking about a kiss or a cross. And I almost got fooled on Monday, believe me. When that thing reversed, I was definitely concerned that, Apple and maybe Gazprom, Russia had derailed the rally. But we did see Russia sort of become softer yesterday on cutting off European gas, and I think that's helped. But in any event, we're now above those moving averages. Look to the 5 as your key stop line now. And in that regard, we did put 25% of our swing strategy into August SPY calls yesterday at the money. And so they're monthly calls. And I think we were at about 38, roughly 38.50 or so when we went in. It might have been 38.45. I'll check on that. But at any rate, we're in on that. We went in on the gap and go yesterday with the calls, expecting that we would sell them later in the day. But as I saw things develop, and as we took out last Friday's high, I went ahead and just kept the position. So we're at least 25% invested. Of course, if I'd known it was going to go up 3%, I would have done more. But we always have to watch out for those one-hit wonders, although I don't think that's what we're dealing with here. So, and again, last night all they did was run the stops up here above these highs from last week. However, like I said, the weekly expected move and the daily expected move are going to provide some resistance here, at least through Friday. And, we do have some things looming out there, Fed meetings, all that kind of stuff. So keep that in the back of your mind. I think the other thing I would look at just generally as all this, kind of develops, this could still be a flagging type of pattern and a rectangle. Let me go to a different view. So just in case this is some kind of a, what would you call this? I don't know in LA terms, but sort of a slanted flag, a rectangle. We still get a move up into this zone here, so I'm keeping that on my charts as well. You may want to draw that in. And I think the other thing of significance is that we are breaking to the upside of the 6-month opening range high. Now, in January and in July, a lot of hedge funds, and this is something that goes back to the 80s when I was running my own hedge fund, we would look at the first 10 days of July and plot the high and the low. And we'd look at the first 10 days of January and plot the high and the low. And whichever way we broke from that would give us at least an initial clue about the last 6 months of the year. And notably, we have broken above the 6-month opening range high here as measured from July. So that may portend good things between now and the end of the year, as hard as that might be to believe. And we've only been above it for a day, so there's a lot to be considered beyond just a one day or one hit wonder. But I do want to point that out to you, and this should provide some support if we're going to really move out of here, and if this does turn out to be a cyclical bear low rather than more of a secular or generational low, then I would definitely watch this line here, which is right around 39, roughly 39.05, somewhere in there, 39.20. Yeah, I think it's 39.20. Let me see here. 39.22. So keep an eye on that line. We want to stay above there if this is a rally that's really going to have some legs and we have any chance of moving out of this abyss that we've been in. Obviously, nobody rings a bell to bottom, and things look bad anytime there's a buy. I mean, you can imagine how bad things must have looked at the bottom in 1929, how badly they looked, our recent memory in the 2009 lows and stuff. So keep that in the back of your mind. Things don't look good at a bottom. They look terrible. And I would certainly say things look terrible. But at a minimum, what I'm forecasting, and let's go back to this chart here, okay? This is a mid-cycle, mid-18-month, 9-month low. And it's an important low, and you can see whenever they occur, they definitely give us a pretty good ride. So that's all we can say right now. It's an important low on June 17th. We're coming out of that. We have a measured move. If we just take this range here and project it higher, we've got a measured move up to 42.20 or so. So let's just go with that for now until something else intervenes. Clearly, we're in the kind of market that we could see things definitely deteriorate on some news. Keep that in the back of our mind. But this is the overall flow. But I do want you to note that at this point, okay, and this is why we may see pressure and we may stay in a bear market. Basically, every major cycle, the 54-month, the 18-month, are going to start their downward projections. And the only thing we're going to have in our favor is the 9 months. So we've got a lot of pressure from these cycles up above us, even though we have a little bit of tailwinds from the 9 month. In a bear market, these cycles tend to peak with left translation. So, if I put that on even a 9 month, somewhere in the end of August, we may see a peak. So keep that in mind. I mean, it's a bear market until proven otherwise. So I'm going to wrap it up there for this morning. Have a great trading day. Head over to the website at blueprinttrading.com, and there's a lot of good information over there. If you like this information, please hit the thumbs up, give us a like, join the channel, subscribe, become a part of this community that we're building. We need your help since we're new on YouTube, so we'd really appreciate your support. And as always, remember that this information is provided for educational purposes. It's to help you learn how the markets work, how we trade, how we approach the markets. Wouldn't be a market if there weren't lots of different approaches. And of course, remember that this is risky business, especially for people that don't have experience. You can lose a lot of money trying to trade, learning how to trade. We used to joke and call it our tuition, but this is definitely not for the faint of heart. So these instruments, especially the leverage instruments, are very, very risky. This is, barely 1 to 2% of people that try to trade are successful at it, and the narrower your time frame, the harder it is. So a day trader is going to have 1,000 times more difficult task than, say, a swing trader, someone who takes a longer point of view. So shorting the market's a lot riskier than going long because you may never see that price again. So keep all those things in mind. This is to help you learn, and not meant to be investment advice or specific advice. And we can't give you advice. We don't know you. We don't know your situation. So take the information, use it to the best of your ability, but don't take it as a recommendation to trade something. So I'll leave you there. Have a great day. A.F. Thornton, Chief Investment Officer of Blueprint Quantitative Strategies, signing